Hi, I'm Doug Sesserman, privileged to serve as Chief Executive Officer of American Associates Ben-Gurion University of the Negev. Welcome to today's webinar on predictable income in difficult times, and certainly these are those. I'm on the virtual subway that I ride generally to the office, but it never looks as empty as this. And now switched to the studio, virtual studio at my office in New York. Joining us today is Neil Meyerberg, who is in his home office in Greenwich, Connecticut. The program today hopefully will be very interesting. And as in past webinars, if you have questions, just click on the Q&A function and you can ask the question. I'll be able to read the questions and then facilitate a discussion with Neil. And for those of you who registered in advance, we have several very interesting questions that were submitted before, and I'll work to get to those also. I'm going to introduce Neil in a minute. He then has a PowerPoint presentation that he's going to use as this webinar. As Neil's presenting, if you have questions, again, just click on the Q&A function. And after Neil's presentation, we'll then open the screen back up. I'll ask Neil questions from the pre-registration list, as well as questions that build during the webinar. So thank you very much. Let's get started. Neil Meyerberg is a well-known authority on tax and financial planning strategies using charitable giving techniques. As an attorney and principal in the firm Meyerberg Philanthropic Advisors, Neil provides consulting services for many of the nation's largest nonprofits, as well as philanthropists on charitable tax planning. He teaches a graduate level plan giving course at Columbia University and is a frequent speaker at national plan giving conferences, as well as a resource to major media outlets, including the New York Times, the Wall Street Journal, and Dateline NBC. He has also been a regular presenter for Consumer Reports magazine and programs throughout the country. Neil has his BS from the University of Baltimore, his master's in science and nonprofit management from NYU, and his law degree from the University of Baltimore. Neil, welcome to the webinar series. We're so glad to have you. It's a pleasure working with you. I'm now going to turn the webinar over to you.
Thank you, Doug, and good afternoon. Good morning, everybody. I'm going to share my screen with everyone. And we're going to talk about this environment, which is the idea of there being difficult times. We know that. And here, sorry. Trying to get started with you. Oh, let me just talk about the concept of predictable income. Many people are aware that banks, treasury bills, things of any sort are difficult because they aren't producing any returns. And as a consequence, we have an environment where people are having difficulty managing their economics because fixed income is very important to people of all ages, particularly people who are older. And so as times get difficult like this, we have two phenomena occurring at the same time. We have very low interest rates. The Fed continues to lower rates, very low interest rates. And the second thing we have a problem is we have a volatile stock market. One might argue with interest rates quite low, buying stocks, investing in stocks is probably a good alternative because the possibility of growth and perhaps dividends are what we're trying to achieve. But the truth is that stocks being volatile don't enable anybody to feel secure. So these times are difficult, both from the health perspective, obviously, but also in terms of the economy. So I'm going to talk today about income generated from a vehicle that many of you know about, that's secure and that has been enhanced perhaps now because of these times. That's the whole idea of fixed income through philanthropy. And so I'm going to talk about, among things, this charitable gift annuity idea. The charitable gift annuity, which is the vehicle that has been available through many charities throughout the country for a long time, has always been very desirable for people who have a philanthropic intention, obviously, but also who are looking for high fixed rate lifetime income, and are also looking for tax-free income and also looking for a charitable deduction. Particularly when interest rates are low, charitable gift annuities thrive. And what's interesting about them when you compare them with commercial annuities is the fixed rate, obviously, the fact of predictable tax-free income, the charitable deduction, and the fact there are no costs, commissions, loans, or fees. They're simply a part of a charitable contribution to a charitable organization. So you'll see on this slide, I show how it works. And essentially what we're talking about is a simple transaction between an individual and a charity. The charity has to be, by the way, a charity permitted to issue gift annuities. All charities can't do that. And particularly in New York State, California, and a number of other states where they're highly regulated, there are a lot of compliance rules to be aware of. Now, AABG obviously is a charity that is based in New York, has national roots, and has been given permission by the state of New York and the state of California and other entities to do this. So that's what you want to look at first of all. Then a transfer of cash or marketable securities by an individual or individuals, it could be one or two people, to a charity is used to purchase this annuity. But what we know about is that the annuity rates are published. At least they're published by the charities, and regulators in the states in which they're filed approve these rates. The rates are based upon the state's need to be certain that the charity has the capacity to pay the annuity. And the states that have rules like New York say there has to be a reserve account set upon. That reserve account is fully funded plus a surplus to assure payments. So in this illustration, you see an individual who gives cash or securities to buy a gift annuity, and the gift annuity will give that person income for life at a fixed rate, usually and certainly increased income from what one would get on the same asset in bank or buying treasuries, an income tax deduction, and some tax-free income. You see the word residuum on the right side of the screen in blue. The residuum means that whatever is left over from the annuity at the end of the lifetime of the individual is what goes to the charity for its charitable purposes. So we're looking at the types of gift annuities. They can be immediate, which means you acquire them and they pay from the time of acquisition, or they can be deferred, which means you actually acquire them today, but payments won't begin to a date in the future. The reason why people use deferred annuities is perhaps they're younger, they don't want to receive payments until they reach a certain threshold age, maybe 72, and they want to leverage from the date of acquisition to the date of payment the compounding of interest that makes the rate much higher. So a 65-year-old who takes an annuity immediately would have a fixed rate lower than the same 65-year-old who says that she or he wants to begin at age 70. So it can be one life or two lives. Can't be three lives, one life or two lives, usually using cash or marketable securities, cannot be other than for life or lives. And so therefore we look at the life expectancy tables to determine rates, and we look at the fact that people's life expectancy, if joint, is longer than life expectancy of either one individually. So here's things to be alert to when you're looking at charitable gift annuities as an option for fixed income planning. First of all, you'll see the slide that says you are your age to your nearest birthday. Essentially what that means is that when you look at a charitable gift annuity and looking for the rate, you want to advise the charity what your date of birth is as opposed to what your age is, because you may be closer to your next birthday. If you are, you get the rate for your next birthday. And so oftentimes when we meet with individuals who are looking for charitable gift annuities, when we get their date of birth, we may say to them, you need to wait maybe for 3 weeks, because in 3 weeks' time, you are your next birthday and you get a higher rate. Now, the slide to the right of that says 2 life rates are always lower than 1 life rate for the younger annuitant. And that's kind of a curious thing. If 2 people are both 65 and their rate jointly is, say, 6% each, the 2 life rate would not be 6%, even though each individual rate is 6%, because the presumption is that people living jointly together have a longer life expectancy than individually. So therefore, the 2 life rate is always lower than the rate for the younger annuitant. Bottom right, the annuity pays no matter whether you outlive the tables or not. The longer life expectancy tables suggest that people on average will live a certain period of time, but then beyond that period of time, the payments continue to be made. And lastly, to the bottom left, and this is something that's curious, but we need to talk about it for a moment. People who make gifts to charity generally using appreciated stock know that by giving stock to charity, they will get a full deduction for value as of the date of contribution and pay no tax on the capital gain. It's a double benefit tax-wise.
Hey, Neil,
Yes,
we're already getting some really good questions coming in, so I wanted to ask one of those questions.
of course.
So one person was just asking for a clarification. So during your lifetime, you receive the annuity personally, but at your death, the residual goes to the charity and not to your heirs. Is that true?
That's right. Unlike commercial product, this is a charitable contribution. So therefore, you measure the results, the economic results, by saying, I'm getting a very high rate, I'm getting tax-free income, and getting a charitable deduction. But when it's over, after the second life is over, whatever remains in it is the charity's use for charitable purposes. That's correct.
And also the return is lower for 2 lives than 1 life. Is that correct?
That's correct, and it's based upon the IRS's actuarial tables, which say that people in a joint scenario will have a longer life expectancy than either one will have individually. So therefore, if that proposition is correct actuarially, the rate for 2 lives will be lower than the rate for the younger person, based upon IRS mathematics. Other questions, Doug?
No, thank you. Keep going. And
Okay.
thank you, audience, for the questions. Again, if you have questions, just click on the Q&A function. I'll do my best to read those and ask them to Neil at the appropriate time.
Yeah, when people, by the way, look at the return of the gift annuity as a purely economic play and look at the yield and look at the net yield after the tax deduction and tax savings and look at the tax-free income, oftentimes the fact that goes to charity at the end doesn't represent an economic loss. Something to think about when you look at calculations. On this screen, I'm pointing out 4 things that we want to talk about, just generally speaking. I just explained 01, which is why capital gains are taxed, because a part of the acquisition of the annuity is a purchase and part is a contribution. The part that is purchased realizes some capital gain, but it's paid in installments over life expectancy, which makes it very soft. One gets a 1099-R at the end of the year, which says how much the annuity was, what part of its tax is ordinary income, what part it's tax-free, and if stock's used, what part is capital gain. Number 2, we have deferred gift annuity plans, which I mentioned before. Well, people might choose to have a deferred annuity paid later on. And to add a piece to that, if you have a deferred annuity and you think you might want to start at 72, you can ask it to be flexible, which means you can get rates from 72 to 87, 15 years, and decide right before 72 which rate you want by which date you want to begin. So this flexible gift annuity is very desirable because you might not know now, but you will know then when you want to really begin to receive your payments. Number 3, IRA distributions. This year, we do know under the Tax Act for 2020, people who require minimum distributions don't have to take anything out this year, which makes 03 different because nobody really will use IRA money except in a larger plan to fund gift annuities. But if you did, there is a tax event when you take the IRA out to buy the gift annuity, softened a bit by the tax deduction by acquiring the gift annuity. And rates for 2 life annuities, as I said before, are based upon the ages of both people. Sometimes you'll have somebody who's an aunt or an uncle who's 90 and a nephew or a niece who's 65 doing a gift annuity. 90-year-old rate is very high. 65-year-old rate is much lower. The gift annuity is driven by the rate for the younger person. Some examples. Best way to know this is to see how it works. So let's take an example. Here's my donor age 75, male or female, who decides that there's going to be a gift annuity acquisition using cash, $10,000. You can see it number 1 at the top. That $10,000 goes to the charity. And the charity then calculates, does in advance obviously, but makes final calculations of what will happen as a consequence of that contribution. So if you look at the chart going down from numbers 1 to 8, you'll see number 1, the annuity was purchased with $10,000 in cash. Number 2, the gift annuity rate for this individual age 75 is 6.5% based on the tables. So therefore, he or she will receive, number 3, $650 a year for life, usually payable quarterly. Some people take monthly, but usually payable quarterly. You get an income tax deduction. When this calculation was made effective very recently, the income tax deduction is nearly 37% of the full purchase price. Now you may ask, why isn't the deduction $10,000? The answer is because part of this is purchase and part's contribution. And so therefore, the present value of the charitable portion that charity will get after 12.4 years, we think here, could be longer, is $3,666. That's the income tax charitable deduction. It's a deduction can be used on your itemized deduction schedule. Line 5, if your tax bracket is federal and state or federal alone, 25%, that deduction, if you use it, will save you $917 in income taxes. That's 25% times 3666. If you look at the math then, you take $917, your tax benefit, away from $10,000, and line 6 says that your net cost is $9,083. Divide that into 650, your annuity payments, and your effective rate is 7.2. But many people say to me, the item on this list that is really the most appealing is that we're going to get 78.6% of our annual annuity amount tax-free for the first 12.4 years life expectancy. If you outlive the table, you still get paid, but after that period of time, 12.4 years, all of the payments are taxed as ordinary income, at which point you will be, in this example, almost 78 years old. So this is cash. Simple example of using cash. Let's take the same individual and make this individual a capital gain stock contributor to acquire the annuity. So you can see the same 10,000.
Hey, Neil,
Yes, Doug.
we're getting lots of questions, so I'm going to feed a couple of them to you.
All right.
This one's from Ellen Marcus. Ellen, thank you for the question. Neil, what is the advantage to funding a CGA before, years before you actually plan on receiving the income?
Advantage, Ellen, is that if you purchase a CGA at a current age, let's say the current age is 60, but you don't really expect or want payments till the age of 70, you will get a rate based upon the period of time from the date age 60 to the date you receive it, which will show you a higher return. So if someone wants to support a charity now, make a contribution now for a deferred annuity, but willing to take the payments at a later date, the money goes in the reserve now. The charity keeps the money safe, it keeps in the statutory reserve, and your rate will be higher at age 70. I'm going to show a slide 2 down from now that will show you the exact example.
Is there any change, Neil, to the tax deductibility portion by making the gift earlier?
The gift earlier tax deduction, if it's deferred, will be smaller than if the gift was paid initially, but the rate will be lower. So if you're 65 and your rate is 5.5 arbitrarily, and you decide to wait till 75 and your rate arbitrarily could be maybe closer to 8 and change, your deduction at the time of the creation of the gift annuity would be lower because of the deferral than if you started the annuity right away, but your rate would be higher if you waited. Something to show you on a coming slide.
Thank you.
Now, let's look at 2 lives. I want to show you the dynamic of 2 lives. Here's a couple ages 82 and 80. Siblings, spouses, whatever. And they, again, looking at a $10,000 contribution of cash, would like to know what the rate would be if they, in fact, did it together. Now, remember that the 75-year-old rate was 6.5% on my prior 2 screens. Now, here's 82 and 80 joint life people. Life expectancy, 12.1 years. Life expectancy for one 75-year-old, 12.4 years. So they make a contribution of $10,000. Let's look down the list now and see how this plays itself out. The purchase price of the annuity is $10,000. Their lifetime rate is 6.5%. Isn't it interesting that the 2 life rate for 82 and 80 is similar to the 1 life rate for 75? Why? Because the joint life expectancy for 82 and 80 at 12.1 years is close to the single life expectancy of a 75-year-old, 12.4 years, purely based upon actuarial data. So they make a contribution of $10,000, 6.5% is their joint rate. It runs through both of their lifetimes. Their payments will receive $650 a year. Their tax deduction is almost identical to the 75-year-old, as is their net cost, as is line 6, their net cost, as is line 7, the amount of the effective return. Their tax-free portion is higher, though. Their tax-free portion is 80.5%. So what you're seeing here are the dynamic of two lives. The two-life rate, because life expectancy expands with joint and survivor, starts to resemble the one-life rate of a younger person. Again, people will say to me, why isn't the rate the same as it is for one life, even though there's two lives? It's because of the IRS's tables which say they're going to live longer. I want to step back for a second to the two-life capital gain property to show you one thing as we look through the screen. In this case, the cost basis of the stock is $4,000. The gain is $6,000. Still the same rate, same payments, same tax deduction, same tax savings. Everything is the same until you get down to line 8. Our tax-free portion in line 8 is reduced compared to the gift of cash because we have a capital gain portion. So our tax-free portion is 31.4%. Our capital gain portion is 47.2%, taxed at long-term capital gain rates. Our ordinary portion is the same. So if you can see when you go back to this slide, the tax-free portion is 78.6%. If you add 31.4% and 47.2%, here you get the same 78.6%. We're just paying some as capital gain income and some as tax-free income. So people have to decide, am I better off using cash or am I better off using capital gain property? It's a question of what the priority is in terms of investment or asset or income planning, because even if you use capital gain property, you will have some capital gain to pay, not on the whole gain, but it's softened by the fact you paid in installments over your life expectancy. Now the deferred annuity, which we were just talking about based on Ellen's question. Let's look at this. Go to age 60. Life expectancy of a donor age 60 is 25.9 years. Makes a contribution of $10,000 and contributes it to create a charitable gift annuity where payments are going to begin at age 70. So the contribution is made presently, and we see in the list from 1 to 8, number 1, the purchase price of this annuity is $10,000. And when you look at calculations, you can just multiply this by 5 or 10 if it's $50,000 or $100,000. The fixed lifetime annuity rate for someone age 70 who begins the annuity calculations at age 60 would be 8.6%. If you bought an annuity at age 60, if their charities offered gift annuities at that moment for a current annuity, that rate would be in the low 5s. So the compounding brings the rate to 8.6% beginning at age 70, which makes the payments beginning at age 70 $860 a year. Now the tax deduction for someone who would have started the annuity right away would be a bit higher, but this tax deduction is 25, almost 26% of the purchase price of the annuity, and the deduction's available now. Your deduction, if you make the contribution now, but deferred payments till the end of this 10-year period, is still the deduction you can take now. If that's the case, you get some tax savings now, as lines 5 shows. If your rate is 25% and you itemize, makes your net cost lower, your effective rate higher, and when beginning at age 70, when your life expectancy is 15.9 years, your tax-free portion is 54.6%.
Neil.
Yes, Doug.
We have an IT genius. Her name's Ronnie Strongen. She also doubles as our Chief Marketing Officer. She's suggesting that you take your mouse and click on the X button in the yellow bar, and that might enable you to do the full slideshow.
All right, let me see my X button on the yellow bar. If I go to slideshow,
see where it says updates available?
Yes.
Go to the right of your screen and click on
I
the
see the X. You're absolutely right. All right,
now go to slideshow.
Let's do the slideshow.
From the beginning.
Slideshow. from beginning.
No?
Doesn't want to allow it. I'm sorry, folks.
All right, thank you. And thank you, Ronnie, for the suggestion.
Yeah, I'm sorry.
We have a glitch in the software.
Yeah, sorry for the screen. I really wish I could do it, but I'm afraid to do too much Xing because I'll lose the whole screen. But so we're
Keep going, Neil. You're doing a great job, and we've got a lot of questions.
good. Okay, let's go back and just summarize what we've done. We've talked about gift annuities. Let me explain something that's not on the screen so that people can get more comfortable. Why would anybody, for example, do a charitable gift annuity with a charity when he or she could do it with a bank or an insurance company? And I think it's because it's a philanthropic adventure, but it also has great security. What do I mean by security? It's a question often asked. How can I be certain that the charity will pay me? How can I be certain that the charity is in a position to honor its commitments? Well, that's why it's interesting to deal with charities. They were registered in states like New York and California and New Jersey and Arizona and Washington and Hawaii and a handful of states that are fully regulated, because those states require, as does New York, the production of a surplus and a reserve fund. And the reserve fund is segregated from all assets of the charity, like an insurance company does. And that reserve fund is reviewed by the regulators every year, end of year reporting. In New York, there's a surplus of almost 26.5% above the obligation amount to assure that even in curious markets, that reserve will be sufficient. And every year, the charity's got to report the reserve and be certain it's sufficient for its risk and sufficient from the surplus, just like an insurance company does when it makes a reserve fund for its obligations. A charitable gift society, charitable gift annuity society is what charities are called, have the same obligations as an insurance company to segregate assets to assure the payment. So when you're looking at a charitable gift annuity from any charity you love, including AABGU, be certain it's registered and approved and based upon the rules of the most stringent states, in this case, the state of New York. So this is charitable gift annuities. And people
Neil, this actually brings up a really good question that Delbert Workington brought up earlier. He was asking, do charities outsource the function for a CGA, like doing it through a third party, and what's the situation with AABGU?
Well, it's a good question. The AABGU, like all other New York-based organizations, is required by law to have the assets in the custody of a trust company. So there are trust companies, including the one that AABGU uses, which have multiple services they provide. They take custody of the assets. They do the investment of the assets, subject to oversight by the charity. They manage the reserve account. They make the payments. They issue the 1099-Rs at the end of the year. They do the reconciliation reports for the regulators. So all that work is outsourced to what we call a fiduciary agent. So all the obligations are there. The charity is the principal obligor paying the obligations of the gift annuity, but the fiduciary agent, the trust company, does all the administration and makes all the payments for the charity. I hope that answers the questions sufficiently.
Keep going. Yep.
I'm going to move on to talk about another kind of life income plan. Gift annuities are easy. The documents are in plain English. The calculations are easy to understand. The application form that one uses to get a gift annuity just asks for details about your date of birth and how you want to be paid, whether it be by direct deposit or by check. And once that's done, it's all processed, sent to the fiduciary agent, the trust company, and you then have a turnkey. And you get your payments on time, and they're paid correctly, and all the information you want to have is available, and you have access to both the charity and the administrative agent to get questions and responses. Let's talk a bit about two other ways to make a life income gift for people looking at larger transactions. These are called charitable remainder trusts. Gift annuities are contracts. They're agreements between you and the charity. A charitable remainder trust is a separate trust. Many of you live in states where you may have revocable living trusts, as opposed to just having everything in individual names, because it's a probate question. You can avoid probate with charitable, with living trusts, and you still have control. They're still you in a different format. This is not the same thing, because this is not a revocable living trust. This is an irrevocable living trust. And it's created in order to get certain benefits from a holding, particularly if the holding is highly appreciated stocks in this case. Charitable Remainder Annuity Trust, acronym CRAT, in a one life example here is an individual who's 75 who has stocks worth $250,000, as you can see. And those stocks have a basis of $50,000. If you look at number 1 on the screen at the top next to the icon, you'll see stocks 250. And number 2, it says the basis $50,000, which means there's a $200,000 long-term capital gain if this individual were to sell these stocks. Well, she's talked to her financial advisor, and her financial advisor said to her, I really want you to liquidate these stocks and do something more safer, less volatile. But she says, if I do that, I've got a capital gain of $200,000. That's undesirable. The tax cost for the capital gain may be higher than the actual benefit I'm going to get from this. So therefore, what's the point? I might as well just hold the stocks and deal with the volatility. So the advisor says, well, here's another choice. If you take these stocks and transfer them to your charitable remainder annuity, just your CRAT, you've created it, you're the donor, you'll be the beneficiary of the income, and you do it with a trustee, or you be the trustee, or charity becomes a trustee, you transfer the stocks into the CRAT at no tax on the gain. The gain on the initial contribution is not taxed. The $200,000 in capital gain no longer is a tax event. So what we have to do then is, because certain rules apply to charitable remainder trusts, determine what the rate will be. The rate is also fixed in CRTs, charitable remainder trusts, like it is in charitable gift annuities, except not based on tables. The rate's based upon IRS rules. And the IRS rule says the rate can never be less than 5% and can be whatever rate you want to set as long as it passes various tests. With the IRS discount rate really low, because it's a function of the 120-day treasuries, we have to look at a rate for an age 75 individual. We look at line 2 below. That rate would be 5.5%. We can't go any higher than that because it would fail these tests. The IRS imposes tests because it doesn't want the rate to be so high that the deduction can't be sustained and that the charity gets nothing at the end and you can't get paid. So the rate of 5.5% says stocks go into full value, no tax on the gain, rate 5.5% of the whole amount times $250,000. The payments will be $13,750 a year. And that payment will be made to you every year with a current income tax deduction of $120,548. That's the tax deduction. Why isn't the deduction the whole $250? Because a part of this is charitable and a part of it's based upon income. That deduction will save some income taxes, reduce the cost, and make the effective yield 6.3%. Now, why would somebody do this? Well, essentially, this person is in a position in financial planning where she doesn't want to retain these stocks anymore because they're too risky. But she also wants to have some guaranteed income, because if she sells the stocks and she makes the cash and she pays the tax on the gain and she has net cash in hand, what's she going to do? A savings account, money market, treasuries? The return would be nominal, if at all. And so a lot of tax paid for no return. So in this case, she said, what? I'll be generous to a charity in the future, generous to myself now, by creating this charitable remainder trust, getting a 5.5% rate, which is the rate I can get based upon the IRS regulations at this moment. I won't pay tax on the gain. I'll get income for life. End of my lifetime, whatever remains in the trust, hopefully it'll be sustained and well managed. Whoever remains in the trust will go to charity to do something good in my name at the end of my lifetime. This is
Neil, in this example, what's the benefit to the donor to getting the CRAT versus using the appreciated securities to purchase CGA at a higher rate?
Well, I think it's a very important question. The reason why lots of people do the CRAT is because they can't tolerate the tax on the gain. Remember, in the charitable gift annuity, some of the gain will be subject to income tax each year as part of the overall tax cost of income received from the annuity. In this case, you don't pay that capital gain tax in the front. It's completely unrecognized. So the choice is, do you use the gift annuity, get the higher rate, get the assured tax-free income, get the tax deduction, but pay some tax on the gain in installments, or do the charitable remainder trust, use the stocks, pay no tax on the gain, get a lower rate, higher tax deduction, but you can't be sure whether you're going to have any tax-free income. What we try to do, Doug, when people make the inquiry is we put these side by side and we show the benefits and the costs of each and the decisions made based upon the overriding best economic result of the two. So I think the answer is it's really case by case, and it matters a great deal about how deep and how large the capital gain is. Now,
Are you or we willing to talk to people's investment or tax advisors to do this kind of analysis?
well, that's one of the services that ABG offers to its supporters and to people who make inquiry. Oftentimes we'll be asked to give some proposals in terms of the mathematics at various stages. Somebody might say, I'm age 65, calculate for me a gift annuity now, a gift annuity when I begin to be 70, a gift annuity with cash, a gift annuity with appreciated stock with a basis of X, calculate for me a charitable remainder trust to compare everything side by side. And will you share it with my attorney, my accountant, my financial planner? Can I bring them into the conversation? Will you discuss with them the cost benefits and what good can come of it at the end and what good comes from me? And can you compare it in truth with what I could do that's not charitable to see whether that may be a better choice for me? And I want to assure people, and this is an important thing to think through, we're involved in this universe of plan giving and these income plans, what we call donor-centered giving, which means we're really more concerned with what is the best result for the donor. It's great to have a good result for the charity, but what's the best result for the donor? So when we do these comparisons that we share with you and with your advisors, we may conclude all of us together that this is not the right time and the right topic and the right result for you. But that's something that we do as a part of the service we give to donors to be certain we look at them first. Let's look just on the sidebar. I want to look at something that's comparable to what we just did. The charitable remainder annuity trust, last screen, fixes a rate, locks in the rate, no changes in payments through life expectancy. No matter what happens to the trust, whether markets misbehave, you still get that payment every year for life, even if life expectancy exceeds the term of years expected. Here's an example of something a bit different. It's also a charitable remainder trust, but instead of being called a charitable remainder annuity trust, it's called a charitable remainder uni trust. The acronym is CRUT, C-R-U-T. Here's an individual who has highly appreciated property, stock, could be real estate, could be works of art, could be illiquid, as opposed to my prior screen where we're presuming the stock is marketable and can be sold right away. And we have, as you see in item 1, stocks in this case, worth $500,000 with a low basis lying to a $50,000. So we have a gain of $450,000 here. And we have a scenario where this individual wants a higher rate, has some market tolerance, and wants a tax deduction that would be consistent with this contribution, and says, if I fund a CRAT instead of a CRUT, what is the difference? Well, number one, look at line 2 below in the list from 1 to 7. The lifetime rate for this individual who's 75 as a CRAT is 5.5, as a CRUT it's 7.0. Now, why is that the case? Because the annual unit trust payment to you in the first year would be 7% of 500,000 or 35,000, adjusts every year. It doesn't adjust by rate, it adjusts by valuation of the trusts. So every year at the close of the year, December 31, the last market day of the year, or the close of the first market day of the next year, we revalue the trust. And we multiply that new valuation times the same fixed rate, 7%, to determine the payments for the next year. If the market is normal, and we don't have a normal market now, obviously, and returns what historical returns might be in a mix of equities and fixed income, highly regarded investments by the trustee, then perhaps it grows a bit more each year than the payment required, and the next year's payment will be higher. But of course, the market might misbehave in a year, and on December 31, it might be lower than it was the prior December 31. So your payments for the next year might be a little lower. It's really year by year. But some individuals have a tolerance for market, want a higher rate, and want, therefore, to have the adjustment made every year. Sometimes it's somebody who isn't completely in need of the assured income each year, but like to share in market production, market performance. So you see in this case, same individual, same age, higher rate. The tax deduction is 50%, a little bit more than 50% of the contribution, $250,000 tax deduction on a $500,000 contribution. The tax savings are higher. Now, why do people use this? It's essentially because you can't put an illiquid asset in a CRAT. And some people have stock or real estate, it could be stock in a private business, real estate or works of art, which are not immediately easy to be made liquid, particularly in these markets. It might say, I want to create this now. I want the trustee to take time selling it in a better market, but I want my deduction now. I want to lock in my rate now. And when the property is made liquid and the trust now has liquidity and invests in a different strategy, I'll begin my payments then. And if it sells adequately, I'll get paid for what was owed me during that period of time before the property actually sold. So people with illiquid assets, like works of art, real estate, or non-publicly traded stock, will use charitable remainder unit trust.
Neil, we're getting some good questions on the CRUT.
Okay.
Lou Winarski and Michael Clinton basically asked the same thing. How do we do the valuation on an illiquid asset like art?
Any asset contributed to a charitable remainder trust, whether it be a CRAT or a CRUT, other than publicly marketable securities, is subject to an appraisal. Now, there's a form, IRS Form 8283, which each of you who created something like this would have to file with your tax return, which states what the asset is, painting by Picasso, and it shows by signature of an appraiser on the bottom of the front page or the second page of the form what the valuation would be. You might have a separate appraisal with it. That appraised value is the value used for calculations all through this CRUT. And we have to have an appraised value that is a reasonable resemblance of value, because if it's overstated, there's a penalty, and you don't want it to be understated. Interesting dynamic is, you have the appraisal, you submitted the 8283, the trust's been created, the asset's been transferred to the trust owns the asset, and let's assume the asset was worth $500,000. If after 3 years the asset hasn't been sold, there is no looking back to valuation. It stands at $500,000 in my example. If the asset is sold within 3 years by the trustee and sells for less than the appraised value, unless it's vastly lower than the appraised value, that won't affect your appraisal and your deduction. It's when the appraisal was vastly overstated and the asset sold before 3 years that the IRS might walk in and say, well, we don't know whether your appraisal sustains the scrutiny it needs, and we may have to adjust. But to be safe with this, the appraisal should be a representative of true value, and whether or not the trustee is able or unable to sell the asset later on shouldn't disrupt the deduction. The appraisal sets the value.
Thank you.
Okay, let me just do this. I want to talk about two pieces of legislation, and then we'll get to questions that happened since 2020 began. One's called the CARES Act. You've read oftentimes about that, and unfortunately it's so much to do with the COVID-19 dilemma. It's so difficult our world is right now. And the Secure Act, which started before this, also effective 2020. And they both have something to do with planning. And I want to show you on this slide, in summary, some few things that you might find interesting. Those people who don't itemize, if you'll see to the left, you'll see the squiggle to the left in the circle. You'll see that the above the line reduction of income for gifts to charity, you now can deduct against income $300,000 individually, $300, sorry, individually, wish it were higher, $600 jointly on a tax return to reduce your income even if you don't itemize. So people who take the standard deduction wonder, well, my charitable gifts I've been giving, I get no tax benefit for them. Well, this new rule set out says that for the first $300 individually or $600 as a couple, you can use that above the line deduction to reduce your income, which in effect gives you a pretty substantial charitable deduction for what you couldn't get before. On the right side, you'll see what appears to be some currency. And it says there now is, and this is brand new and could be very important to some of you, in 2020, you are not limited to how much you can deduct for a cash contribution to charity, outright, an endowment, a gift annuity, a charitable remainder trust, up to the full amount of your adjusted gross income. The rules were until now that you could only deduct up to 60% of your AGI for charitable contributions of cash, and anything that was in excess of that amount, you could carry over and deduct it next year and carry it over year by year for a total of 5 additional years. But this year, if your adjusted gross income is $500,000 and you make a charitable contribution to AVGU or creating a charitable remainder trust or a gift annuity for the same amount of money, $500,000, you write the whole thing off in the first year. And that's a new rule, and it can be very desirable in terms of people thinking of make charitable contributions this year. Whether that will be the rule in 2021, one would not know. But the AGI limits are waived. Any gifts in cash up to your AGI are fully deductible this year as charitable contributions without limitation. On the bottom left, we're talking about the Secure Act, which came before the CARES Act. And many people are troubled by this in terms of their own financial planning. And looking at up left, it says, and we know this now, people who inherit retirement plan accounts, IRAs, 401ks, etc., say children of yours who inherit these, used to be you would inherit them and you could take your payments based upon the life expectancy of the inheritor. So therefore the child may be, say, 60 life expectancy, 20 some years. You can soften the tax flow by only taking the amount you have to take in RMD distribution year by year and spread it out over life expectancy. So your tax costs would be much softer. As you may have read now, the rule has changed. In inherited IRA, distributions must be taken no longer than 10 years after receipt, which increases the tax cost, increases the revenue for the government, and reduces a significant benefit that people had, which was, I'll just pass my IRA on to my son or to my daughter or to my sons and daughters, and they will pay tax slowly, which will make their net return from the IRA better year by year when they need it. That rule has changed. So there's a lot of challenges now for tax planning. What is one doing? And I offer to you on the bottom right a charitable solution. This has been around a long time, but it wasn't compelling because people had other options. Go back to your thinking about the charitable remainder trust I showed you before. If at the end of the lifetime of the IRA owner, he or she says, I would have this transferred to a, let's say, a testamentary charitable remainder trust, something set up in my will. I'll transfer the entire IRA amount to that charitable remainder trust, and that charitable remainder trust will then be set up to make payments to my child or children at a stated fixed rate for the rest of their lifetimes. They no longer have, there's no longer an inherited IRA issue. The IRA has been fully inherited or passed on to the charitable remainder trust. It pays over life expectancies, over lifetimes to individuals at a stated rate. Taxes only paid on what's received and however the taxes are to be described. We've changed the 10-year problem into a situation where the payments will be softened over many, many years. At the end of the term of the charitable remainder trust, like at the end of the term of a charitable gift annuity, everything that remains what's called residuum in charitable gift annuities and remainders in charitable remainder trust, whatever remains goes to the charity. But if you look at the economics again, I'm assuming, and I think I'm talking to people who believe this, that the basis of what we're talking about is because in your heart of hearts, you want to leave the world a little better than you found it, that you want to do good, and you want to do good by making gifts to charities you believe in, who themselves do good for the world. If that's the case, and that's the proposition you begin with, then the economic designs of these transactions can be made to fit what you're trying to do from an income tax, investment return, or estate planning point of view, that's what these do. And this option on the bottom right is exactly that. How do we solve this new problem by joining with charity to make a solution that's good for the family and good ultimately for the community or the world that the charity serves? So in essence, and you can see this if you want, I have 2 slides I won't review that sets what these are out in more narrative form. And so that's there for you to take a look at. And of course, you can always ask to have a copy of this outline. And lastly, I just want to show you something, because I couldn't produce the full table rates for you. It would have been difficult to show, but I'm showing you rates for gift annuities at ABGU, for example, in 5-year intervals. You can see 65, 70, 75, 80, 85, 90. And you can see the stated rates, and between 65 and 70, the rates continue to go up between each of the age categories. When you're 90 and go older than 90, it stays at 9.8. And you can see the tax-free portion, pretty compelling. You know that any annuity you get at these age thresholds, the payments will come back to you 3/4, 80%, 85% tax-free, depending upon your age. We calculate that tax-free portion for the month you create your gift annuity. This table of rates is abbreviated. You're free, please, to ask ABGU for the entire table of rates from 65 to 90, so you can see what applies to your particular age. Remember, your age to your nearest birthday. And number 2, you can also get a detail about tax-free. And number 3, you can get some information about 2 life rates, you and someone else, or the 2 of you together. So Doug, I've pretty well given the overview of this topic, predictable income in difficult times, emphasizing that the predictable income comes in partnership with charity, with a charity you believe in, with ABGU. We can see these are difficult times. I don't know whether we have any reason to believe, if you look at the inflation indexes for the documents that relate to inflation, you can see that there's no predictability that things are going to go up while rates could get even lower. Returns on a fixed income in banks, money markets, treasuries, without taking risk are very low. These are difficult times to plan that piece of your ultimate life. Estate planning, investment planning, income planning, all very important factors now. But please, most important of all, everyone, stay well. Doug, I turn it to you for questions and comments.
Great. Thank you very much, Neil. We've got several questions and we still have a few minutes left before 1 p.m. Eastern. So if you can stop the share on your screen, the audience will be able to see both of us.
Okay, we are.
Okay, great. So a couple of questions quickly, and then I'm going to go to some of the questions from the pre-registration. Ellen Marcus asks, does the unlimited deduction up to 100% of the AGI apply to real estate and art, et cetera, or only to cash donations?
Well, it's specific to cash. They've made that concession to cash. You're still subject to the 30% rule for appreciated assets of AGI, 100% for cash.
Thank you. An anonymous attendee is asking on the gifting of appreciated assets, can someone define the period from which the assets are liquidated, or is that solely the responsibility of the charity?
Well, the IRS caught wind of that many years ago and said we don't want the donor to control the sale of the assets. So even if the donor is trustee, the donor has to appoint a committee of 1 or more that makes the decision about the sale of the assets. Can't be anyone related by blood or marriage or employment, but in reality, this is a conversation that people have one to the other, but the donor cannot control when the sale will occur.
Thank you. One of the pre-registration questions was, is there an ideal age or a minimum age that one can purchase a CGA? Is 62 young? Is 92 old?
Well, I think there's never too old, because the rates are so compelling, and older folks particularly are looking for fixed income to help them in their later years and help them in their retirement. Too young, I think that 65 is probably the best age, because that's still a rate of return that's very nice compared to what's going on now. And a lot of people say they're not really ready to lock in their capital for income until they get to that point. That used to be, we may all recall, the retirement age. It's no longer. Now it's The IRS now says 72 is your age that you're required to take minimum distributions, but I'd say 65 on the young end, and there is no real reason to think anyone on the older end might not find this desirable.
So 65 is not a legal limit, that's a recommendation.
Yeah, I'm just recommending. I mean, somebody might want to do it at 60, but you have to measure the cost benefit. You put the capital up at 60 and your rate is 4.8. What you're saying is, I'm going to take that, be satisfied with that return for the rest of my life, and your life expectancy is 20 some years. Still a good idea, because some people really want, as part of their portfolio, something they can count on. The point I would make is that in these kinds of difficult situations, it isn't a bad idea to lock in what I call a lifetime certificate. It's like a lifetime CD. You're buying a CD called a gift annuity, locking your rate for lifetime, and you put it aside and say, I don't have to worry about that. I've got that capital assured when I get payments, and I'll deal with risk with other assets.
We received a couple of questions asking about how does the charity, in this case, how does AABGU or Ben-Gurion University itself benefit from a CGA program if the charity actually has risk because of the promised income stream to the donor?
It's a good question. The mathematics of charitable gift annuities presume that over the period of time of the annuity, the average annual return on the reserve account will be 4.5%, and that the person lives normal life expectancy. If that's the case on the universe of our annuitants, the charity will expect to receive between 50 and 60% of the contribution at the end of the lifetime. Charity never anticipates mathematically receiving the full contribution. So the question is, what's the charity's benefit? Well, at the end of that period of time, there's maybe 50% of the amount that was contributed goes to the charity for general charitable purposes, maybe for the charity's endowment. And so yes, there's a benefit for the charity deferred, but there is a benefit that's predictable based upon the mathematics.
Right. From experience, we've seen a number of our donors, and they end up outliving their life expectancy tables. And while we may lose money on the CGA, generally the donors are engaged with our work in supporting the student scholarships and the research and all the remarkable work at the university and at AABGU.
And so we used to do an anecdote which said if people, charitable gift annuity people tend to live longer, and we meant it tongue in cheek, but there's evidence of it. And then a couple of years ago, the body of people who look at these things, look at rates, said, you know something, we're going to survey charities and see if that's the case. And they went to various charities and say, what is your experience? And they're saying, well, people are living longer. You wonder whether the rates are driving longevity or whether people just keeping themselves much more healthy.
We received a question about the pandemic and its impact on the stock market. How does that affect the rates that you showed on your last slide?
Those rates are filed with the state of New York in this case, and state of California, and they will be the rates. That doesn't mean the charity might not file new rates at some point in the future, whether it be up or down rates, but the rate you get in the gift annuity contract is the fixed rate irrespective of the market. And the state of New York says your surplus will have to, and your reserve will have to reflect that, but the rates will never be reduced based upon what you apply for.
Okay, thank you, Neil. It's 12:58. Before I wrap up with some closing comments, did you want to end with anything? We've done a nice job working through the questions.
No, I'm glad for the questions. Anybody who wishes to ask any more questions, you're free to contact plangiving at aabgu.com and aabgu.org, and they'll send the question to me, and I'll be glad to respond to you and give you some information. You're hearing an awful lot in a short period of time, and oftentimes questions will arise afterward. We're happy to help.
Very good. So I'm going to attempt to share screen here. Hopefully people can see this. If you do have and are looking for more information, you can just go to our website, aabgu.org/plangiving, or email directly plangiving@aabgu.org, and we'll be sure to get back to you and also put you in touch directly with Neil. And for upcoming events, please spend some time on our website, aabgu.org. It's chock full of great information about who we are, the terrific research at the university, different ways to get involved. We have a number of events coming up. Today is May the 5th. We're doing this webinar on predictable income in difficult times. We have an amazing, Ben-Gurion University has become the leading university in Israel in terms of multidisciplinary task force responding in different research initiatives to the crisis. We're doing our third webinar on the task force on May the 13th. On May 17th, Ben-Gurion University is doing a virtual open house and mini Board of Governors meeting. And then we're also going to feature on May 27th some of our doctors who are working on the front lines of this crisis. Ben-Gurion University has two terrific medical schools, one taught in Hebrew, one taught in English. The English program is called the Medical School for International Health. Many of the alumni work in the States. We're going to feature a number of them as panelists. And then in September, we are working on our plans for our AABGU annual meeting, which currently is called to be in New York on September 15th and 16th. We're trying to decide if it's going to be in person or virtual. And Ruth Bader Ginsburg was going to be receiving her first ever honorary doctorate from an Israeli university, from Ben-Gurion University. And we're working to enable that, whether it's in person or virtual. So thank you all for joining us. I want to, in particular, thank our speaker, Neil, and Melody Mokhtarian, our Director of Events and Experiences, for putting together this terrific webinar. And stay healthy, be safe. Thank you very much.
Bye, everybody.